Welcome back to the Deep Dive. It is Sunday, February 1st, 2026. And I have to say, if you are sitting there staring at your portfolio, or maybe just staring at the news headlines and feeling a distinct sense of emotional vertigo, you are definitely not the only one. It has been quite the week.
Quite the Week is doing a lot of heavy lifting there. I think whiplash is really the only word that fits.
Whiplash is a good word for it.
I mean, we've essentially lived through two entirely different economic eras in the span of, 120 hours? It's been nuts.
It really does feel like that. I was looking at the charts on Tuesday morning, and then I looked at them again on Friday afternoon, and I thought my data feed was broken. We saw historic highs and historic crashes, sometimes in the exact same asset class, separated by just a few days.
It's incredibly rare to see the sentiment pendulum swing that hard that fast. Usually a market narrative takes weeks, maybe months to shift.
Right, it's like turning an oil tanker.
Exactly. This time, it turned on a dime. It shifted in the blink of an eye.
So let's look at the menu for today because it is absolutely packed. We started the week with what they're calling the fear trade, gold, silver, crypto going absolute supernova. I mean, numbers that look like typos on the screen.
Oh, absolutely.
And then by Friday, just completely face planting into the concrete.
A classic violent boom and bust cycle, but compressed into a single trading week. It's something you study in textbooks, not something you see in real time.
And then, of course, we have to talk about Washington. The Federal Reserve, which, usually moves at the speed of a tortoise, got a massive jolt. President Trump nominates Kevin Warsh to replace Jerome Powell, and suddenly the entire calculus of how we think about money, interest rates, and inflation just changes overnight.
And honestly, I think that nomination is the linchpin. If you want to understand the week, you have to start there. It explains so much of the chaos we saw elsewhere.
We're going to get deep into the Warsh doctrine in a bit, but we also have to talk about Silicon Valley. The Magnificent Seven trade. It feels like it's dead.
Oh, it's fractured. At the very least, it's fractured.
Or at least it's no longer a monolith. We have Microsoft losing $400 billion in value, which is just a staggering amount of money to vanish, while Meta is surging.
That divergence is crucial. I think we've officially moved from the promise phase of AI, the hype phase, to the show me the receipts phase.
Show me the money phase.
Right, yeah.
Exactly. And finally, just to keep things really light and easy, we have big ships heading to Iran, a change in military doctrine from Tehran, and threats of a full-scale regional war.
Yeah, the geopolitical shadow is darker than it has been in months. It's a serious variable that you can't ignore.
So here is our mission for today. We aren't just going to read the headlines. We are going to try to synthesize this because I have a feeling that a nomination in D.C., an earnings call in Redmond, and a naval destroyer in the Persian Gulf are actually all part of the same story. It's a story about risk, productivity, and, I guess, where this economy goes next.
That's the goal. Connecting the dots is where the real insight is. It's the only way to make sense of this kind of noise.
All right, let's start with the chaos. I want to go back to the beginning of the week, Monday, January 26th. Set the scene for me. What was the vibe in the markets?
Panic. It was pure, unadulterated panic buying, but not panic buying toilet paper like in 2020. This was capital flight on a grand scale.
Capital flight, okay.
If you looked at the flows on Monday and Tuesday, you saw investors fleeing everything that looked like a standard currency or a government bond. They were running for the exits of the traditional financial system.
And when you run out of the traditional system, where do you go? Where does that money land?
You go to hard assets, the ultimate, non-sovereign safe havens,
Yeah.
Gold, silver, Bitcoin, things that a government can't print more of.
And they didn't just trickle into those assets, they flooded in. Gold surged past $5,000 an ounce for the first time in history. I remember looking at the ticker and seeing $5,110.50.
It's a mind-boggling number.
I mean, do you remember when $2,000 felt like this impenetrable psychological barrier? It took years to break.
Oh, yeah. It felt like the top of the world. And this move, it blew right through it like it wasn't even there. But, gold was actually the calm one in this whole mess.
Really?
Yeah, silver was the one acting completely unhinged. It was trading around $110 to $117. The volatility was just off the charts. Intraday swings of 10, 15%.
So why Monday? Why did the collective consciousness of the market suddenly decide that was the day the world ends? What was the trigger?
It was a convergence of three specific fears, like a perfect storm. First, you had Trump's threat of 100% tariffs on Canada.
Which seems to come out of nowhere.
It did. And it really spooked the currency markets because it implies a trade war with our biggest partner. It introduces a level of chaos that nobody was modeling.
Okay, that's one.
Second, you had genuine fears of a U.S. government shutdown, which always makes people nervous about the full faith and credit of Treasury bonds.
The usual DC drama, but amplified.
Exactly. And the third was, of course, the looming conflict with Iran. But I think there was a deeper psychological driver here underneath all of that. The market was pricing in what we call an independence crisis at the Federal Reserve.
An independence crisis. Explain that.
Right. The fear was that the central bank was going to lose its autonomy, that it was becoming a political tool, that the White House would just direct the Fed to print money to solve problems, to pay for tariffs, to fund the government during a shutdown, you name it.
So the idea that the dollar is no longer a stable store of value.
Precisely. When investors fear the referee is rigged or that the dollar is going to be debased to pay off debts, they stop playing the game. They buy gold because it's the only thing that doesn't have a counterparty risk. It's just an asset.
Okay, so that's the setup. We are living in a Mad Max economy on Tuesday. Everyone is buying gold bars and building bunkers. And then comes Friday, January 30th, the reversal.
It wasn't just a reversal, it was a liquidation event, a cascade failure.
Walk us through the carnage, because the drop was just as violent, if not more violent, than the rise.
Gold dropped 11% in a single session. Now, for a stock, 11% is a bad day. For a currency or a major commodity like gold, that is a crash. That is almost unheard of.
It's a limit down kind of move in other markets.
Absolutely. But silver plummeted over 30%.
30% in one day.
It was a historic collapse, one for the record books. And it wasn't just metals. The contagion hit crypto incredibly hard. Bitcoin fell from near $90,000 to below $76,000. Ethereum dropped over 8%. Everything that had been a safe haven was suddenly toxic.
I saw a stat that just blew my mind regarding the crypto drop. It wasn't just people selling their coins. It was forced selling on a massive scale.
The liquidation cascade. It's the market's most brutal feedback loop.
Right. A single-day liquidation of $2.2 billion in crypto futures. That's a number that's hard to wrap your head around. Over 335,000 investors wiped out.
Let's explain the mechanism there, because liquidation sounds technical, but it's actually a very brutal mechanical process.
Please do.
So you have legions of traders who were betting that the price would keep going up. And they were using leverage borrowed money. They put down, say, $10 to control $100 of Bitcoin.
So they're amplifying their bets.
Massively. Now, when the price starts to drop, even a little, the exchange's computer system sends an alert. It says, hey, your $10 doesn't cover the risk anymore. Your position is underwater. Give us more money. That's the margin call.
And if they don't have the money or can't post it fast enough,
the exchange automatically sells their Bitcoin to cover the debt. It's not a person. There are no questions asked. It's an algorithm. Now, imagine that happening to 335,000 traders all at once.
it feeds on itself.
The selling drives the price down, which triggers the next guy's margin call, which drives the price down further. It's a domino effect. That's how you get a flash crash and lose $2.2 billion in a day.
It's a classic long squeeze. Everyone was on one side of the boat, betting on higher prices, and the boat just tipped over.
Exactly. It wiped out months of gains for retail traders who chased the high at the last minute, a really painful lesson in leverage.
So the $2.2 billion question is, why? What on earth happened on Friday to turn the fear trade into a fire sale? Because the tariff threats didn't go away, the Iran situation didn't get better.
No. In fact, you could argue the geopolitical risk got slightly worse over the course of the week. But one variable changed. One name entered the chat. Kevin Warsh.
The new Fed nominee?
Correct. On Friday, President Trump nominated Kevin Warsh to be the next chair of the Federal Reserve. And the market looked at Warsh and let out a collective sigh of relief. They said, okay, the worst case scenario, the total destruction of the dollar is off the table.
Unpack that for me. Why is Kevin Warsh, of all people, the kryptonite to the gold rally? What about him calmed everyone down so dramatically?
Because the market feared a sycophant. They feared a political appointee who would just say, yes, Mr. President, and turn on the printing presses until the ink ran out. Warsh is viewed as credible and institutional. He's a former Fed governor. He was there during the 2008 crisis. He's a known quantity.
So he's considered an adult in the room. He represents stability.
He represents institutional stability, yes. The fear trade evaporated because the threat of total dollar debasement and the loss of Fed independence was suddenly perceived as much, much lower. The adult in the room premium came back, and the end of the world premium vanished in an instant.
That is just fascinating. One man's name on a piece of paper wipes out 30% of the value of silver. It really shows how much of finance is just psychology and trust.
Central banking is 10% math and 90% credibility. Warsh, in the market's eyes, restored the credibility.
Well, let's dig into that credibility. Because while the market cheered the idea of him, his actual policies are, let's say, distinct. They're not exactly mainstream right now.
Yeah, that's a very polite way of putting it. He's a bit of a hawk with some very unconventional ideas.
So let's talk about the Warsh Doctrine. Who is this guy, really? I know he's a veteran, but he's not a clone of Jerome Powell, right?
No, definitely not. He's almost the anti-Powell in some ways. He was a Fed governor from 2006 to 2011, so he was in the trenches with Ben Bernanke during the global financial crisis. He knows where all the bodies are buried.
He saw the system break firsthand.
He did, and I think that experience forged his philosophy, which is very different from the current consensus at the Eccles building.
How so? What are the core tenets?
There are two main pillars to the Warsh Doctrine as I see it. First, and most importantly, he is aggressively anti-QE, anti-quantitative easing.
That's the money printing. The Fed buying up government bonds to keep interest rates low.
Exactly. The Fed buying trillions of dollars of government debt to keep rates low. Warsh has argued for years that this is a dangerous distortion. He believes it creates asset bubbles, it misallocates capital, and, most controversially, that it subsidizes Wall Street at the expense of Main Street.
He thinks the Fed's balance sheet is bloated and needs to go on a serious diet.
A crash diet. He's been one of the most vocal critics of the scale of the Fed's interventions post-2008.
Okay, so pillar one is stop manipulating the bond market. What's pillar two? This is the one that really connects to the tech story.
Pillar two is the really interesting part for where we are right now with tech. Warsh is a massive believer in supply-side productivity.
Break that down for us.
He believes that we are on the verge of, or perhaps already in the middle of, a massive productivity boom driven by artificial intelligence. His theory is this: if AI makes every knowledge worker 50% more efficient, we will produce way more goods and services with the same number of people. When you flood the market with goods and services, what happens to prices?
Supply goes up, prices go down. It's Econ 101.
Exactly. Disinflation. Warsh argues that this productivity boom is naturally disinflationary. It's a powerful force pushing down on prices.
Okay, that makes sense.
And here is the controversial part, the part that really changes the game. He believes that because AI is keeping a lid on prices, the Fed can actually cut interest rates and run the economy hotter without causing runaway inflation.
Wait, run that by me again. He wants to cut rates because of a strong economy. That's the opposite of how it usually works.
It's a complete inversion of the traditional model. The Powell Doctrine is data dependence. If growth is hot and unemployment is low, you raise rates to cool it down and prevent inflation.
The old Phillips curve trade-off.
Right. Warsh is saying that AI breaks the Phillips curve. He thinks high productivity allows for faster growth without inflation. So you can cut rates not because the economy is weak, but because it's strong and productive.
That sounds a bit like having your cake and eating it too. Faster growth, lower rates, and no inflation. That sounds almost too good to be true.
It's the supply-side dream. Think of the 1990s. We had the internet boom, huge GDP growth, wages went up, but inflation stayed low because technology was making everything cheaper and more efficient. Warsh is essentially betting that we are in 1996 all over again, but with AI instead of the internet.
But isn't there a massive risk there? If he cuts rates thinking AI will save us from inflation, and it turns out AI is just a chatbot that writes bad poetry,
then inflation explodes.
Right.
That is the massive risk. If he's wrong about the timing or the magnitude of the productivity gains, then cutting rates would be like pouring gasoline on a fire. We'd see 1970s-style inflation come roaring back. It's a huge gamble on a technological thesis.
And his nomination isn't exactly a done deal, is it? I saw some headlines about drama brewing in the Senate.
Oh, there is plenty of drama. This is Washington, after all. It's never simple. Republican Senator Tom Tillis, who sits on the powerful Senate Banking Committee, has vowed to block any nominee for Fed chair.
Any nominee, even a Republican pick from a Republican president. Why?
It's leverage. There is an ongoing Department of Justice investigation into Jerome Powell regarding some building renovations at the Fed. It sounds petty, but Tillis is using it. He says until that investigation is resolved to his satisfaction, nobody gets confirmed. He's holding the entire process hostage.
So this could drag on for months.
It could. And Powell, he's not just packing up his boxes and leaving in May.
Right, this is the other awkward part.
It's very awkward. Powell's term as chair ends in May 2026. But his term as a board member, just a regular governor, runs until 2028. He has stated publicly that he intends to stay on the board even if he is replaced as chair.
Wow. So you could have the old boss sitting in the meeting with the new boss, voting on interest rates, potentially challenging him in real time.
It creates the potential for a massive power struggle and a very, very awkward dynamic in that boardroom. Imagine trying to lead a meeting where your predecessor, who fundamentally disagrees with your entire economic philosophy, is staring at you from across the table.
I would not want to be the intern bringing coffee to that meeting. That sounds incredibly tense. Now let's look at the market reaction to Warsh specifically. Bonds. Usually the bond market tells the truth, even when stocks are lying. What did the bond market say?
It gave a very nuanced and I think very smart signal. Bond yields rose. The 10-year Treasury went up to 4.27%.
Wait a second. If Warsh wants to cut rates, why did yields go up? Shouldn't they go down in anticipation?
This is where we have to talk about the shape of the yield curve. The yield curve steepened. Here's the mechanism. The short-term rates, the 2-year note, which the Fed controls directly, those are pricing in potential cuts. But the long-term rates, the 10-year, the 30-year, those are determined by the market's expectation of growth and inflation over the next decade.
Okay, so it's a tale of two different time horizons.
Precisely. By selling off the long bonds, which pushes their yields up, the market is saying two things. First, we think Warsh's policies will create more economic growth in the long run. Which is good, but they are also demanding a higher term premium.
Term premium.
It's the extra compensation, the extra yield investors demand to lock up their cash for 10 or 30 years. Because Warsh's strategy is new and maybe a bit risky, investors are saying, if you want me to hold this debt for a decade, you have to pay me more, because I'm not 100% sure this isn't going to cause inflation way down the road.
So short-term relief, but a long-term risk premium. It says, we believe in the growth story, but we also want to be paid for the uncertainty.
You've nailed it. It's a vote of confidence in growth, but a hedge against long-term inflation. A very sophisticated reaction.
It's complex. Everything is so interconnected. And, speaking of interconnected, we just spent, 10, 15 minutes connecting the spot price of silver to the specific monetary philosophy of a guy named Kevin Warsh and the internal politics of the Senate Banking Committee. Most headlines just say silver crashes. They don't tell you why.
That's the difference between information and insight, right? The headline is information. The why is insight.
Right. And if you are the kind of person who wants the insight, who wants this level of dot connecting every single week, you need to do us a favor. Pause this right now and hit the subscribe button on the YouTube channel. Like the video. Leave a comment.
And here is why that matters. The algorithm, for better or worse, is a feedback loop. If you click on hype, it feeds you more hype. If you engage with depth, it learns to show you more depth. By subscribing, you aren't just helping us, you are curating your own information diet for the future.
You're basically training the AI to make you smarter. So hit subscribe. Okay, let's pivot. Segment 3. Big tech earnings. We call this the show me the money phase in our notes.
The honeymoon is definitely over for AI promises. The market wants proof.
It really feels that way. For the last 2 years, we talked about the Magnificent Seven moving as a block. You bought one, you basically bought them all, and you made money. That trade seems completely dead now.
It is fractured completely. The correlation between those stocks is gone. The new market rule for 2026 is simple. It is not enough to say AI will be huge in 5 years. You have to prove it is making money right now.
And the context here is just huge. Tech earnings are expected to drive something like 60% of all S&P 500 growth in 2026. If they sneeze, the whole market gets a cold.
Correct. And last week, Microsoft didn't just sneeze. They caught a pretty nasty flu.
Let's talk about Microsoft. They were the big loser of the week, no question.
Big time. The stock fell about 10 to 12% on Wednesday. It was their worst single trading day in months.
Wiping out $400 billion in market cap. I just want to pause on that number. $400 billion. That is roughly the entire GDP of Austria. Gone in 6 hours. Why? What went so wrong?
In 2 words, capital expenditure, CapEx.
The spending money. How much they're investing to build out their infrastructure.
Right. And the number was just eye-watering. They are projecting to spend $110 billion in 2026 alone on data centers, on servers, on NVIDIA chips.
110 billion. That is an astronomical amount of cash.
Oh.
More than most countries spend on their entire military.
It is, and investors looked at that bill, then they looked at the growth of Azure, their cloud business, which is the key proxy for AI demand. And Azure growth was good, don't get me wrong, but it was slightly slower than the whisper numbers.
The whisper numbers being the unofficial but often more important expectations on the street.
Exactly. So you have this equation in the market's mind. Massive, massive spending, $110 billion, and revenue growth that isn't exploding quite as fast as people hoped. Investors got spooked. They are worried about the return on investment. Is this a bottomless pit of spending, or will it actually generate a profit?
And there was another detail that came out, something about OpenAI, right? A risk factor.
Yes. This was a detail buried deep in the filings that really scares people, if you think about it. It was revealed that nearly half of Microsoft's Azure backlog—
The backlog being the future revenue they are counting on from contracts they've already signed.
Correct. Nearly half of that backlog is attributed to a single customer, OpenAI.
Half from one company.
Half. That is a massive concentration risk. Basically, Microsoft is renting servers to OpenAI and counting that as future revenue.
Whoa.
But if OpenAI struggles or can't pay its bills, or if the AI model bubble pops, then Microsoft has a massive hole in its balance sheet. It's a very fragile, codependent ecosystem.
It's like being a landlord whose only tenant is a buzzy startup that hasn't actually made a profit yet.
That is a perfect analogy, and the market suddenly realized how risky that is.
Okay, so Microsoft is in the penalty box for spending too much with uncertain returns. But then you look at Meta, Facebook, Instagram, and they're having a party. Stock up 10%, hitting new highs. Why did Mark Zuckerberg win where Satya Nadella lost this week?
Because Zuckerberg showed the receipts. He didn't just promise an AI future. He showed, with data, how AI is improving the core business, the advertising engine, right now, today.
So it's not some future project, it's impacting the bottom line.
Yeah. The AI algorithms are getting much, much better at predicting what you want to buy. They're improving engagement on Reels. They're showing you more relevant ads. That makes the ads more valuable, which means advertisers are willing to pay more for them. It's a direct, measurable line from AI investment to quarterly profit.
Plus, they finally cut the metaverse spending, right? That had to help.
Finally. The market has been screaming for this for years. They cut spending on the Reality Labs, the metaverse division, by 30%. Remember when that was all they talked about? Now they are reallocating that cash to the Manus AI initiative. Investors love that pivot. Stop burning cash on cartoon avatars with no legs. Start spending cash on algorithms that sell shoes.
It's pragmatic. It's profitable. The market loves it. Now, what about Apple, the silent giant in all this?
Apple is in a weird spot. On paper, their quarter was incredible. They posted record quarterly revenue, $143.8 billion. iPhone sales were up 23% to over $85 billion.
Those are just unbelievable numbers. I mean, they are printing money.
They are, but the stock is sluggish. It was down about 5% on the year before the earnings, and it didn't really pop much afterwards.
Why? If they're selling a record number of iPhones, why isn't Wall Street happy?
Because of the narrative, the story. Investors feel Apple is missing in action on generative AI. Compared to Google with Gemini and Microsoft with its OpenAI partnership, Apple doesn't have a flashy AI story yet. They're seen as a cash cow, reliable, profitable, but slow rather than a growth engine. And the market pays for growth.
They need that AI magic dust to get the high valuation, the high multiple, where hardware sales aren't enough.
Exactly. And some of their smaller segments, like Mac and wearables, actually dipped a bit, which reinforced that narrative that the growth story outside the iPhone is stalling.
Now, I want to spend some time on a term that kept popping up in the research notes. It's a term that I love, but it also kind of terrifies me. Vibe coding.
Yes. Vibe coding.
Ugh.
This was the buzzword that absolutely killed the enterprise software stocks this week.
Explain this to me. What is vibe coding, and why did it make stocks like Salesforce and ServiceNow and Workday just tank?
So vibe coding is the idea that AI models are getting so good at writing and debugging computer code that you don't really need to be a programmer to build sophisticated software anymore. You just type in plain English, you describe the vibe of the app you want, and the AI writes the code, fixes the bugs, and deploys it for you.
Okay, so I can just type in, build me a system to track all my customer interactions and send them automated follow-up emails. and it just does it.
That's the direction we are heading. Tools like Replit Agent or Cursor are already doing rudimentary versions of this. But think about what that does to the business model of a company like Salesforce.
Salesforce charges a subscription fee per employee, per seat. It can cost a big company millions a year.
Right. Their whole business model is software as a service. You rent their complex software because it's too hard and expensive to build your own. But if vibe coding allows a small team or even one person to build a bespoke customer relationship management tool over the weekend for pennies, why would you pay Salesforce millions of dollars a year?
It completely destroys their moat. It commoditizes what they sell.
Completely. The fear is that we are moving from SaaS to service as software. The software itself becomes a commodity that anyone can generate on demand. That is an existential threat to the entire enterprise software industry.
That is a wild paradigm shift. We are talking about the potential destruction of a trillion-dollar business model that has dominated tech for 2 decades.
And investors are voting with their feet. They are dumping the software companies. But notice the flip side of this trade. While those software stocks tanked, the pick and shovel plays sword.
The hardware guys, the ones who make the gear.
Lam Research, SanDisk, Western Digital, the companies that make the semiconductor equipment and the memory chips, they are soaring.
Because whether you are buying a license for Salesforce or vibe coding, your own app on an AI platform,
You need chips and you need memory to run it.
the AI needs massive amounts of memory and processing power to write that code. So the hardware is the safe bet in a software war.
Exactly. It's the 1849 gold rush all over again. Don't waste your time digging for gold. Just sell the shovels to all the prospectors.
Or in this case, sell the GPUs and the high bandwidth memory and the solid state drives.
Precisely. It's the safest way to bet on the revolution without having to pick the winner.
Okay, so we have the Fed trying to stick a very difficult landing with a new philosophy, and we have tech trying to justify its massive spend while fighting off an existential crisis in the software sector. But looming over all of this is what's happening in the Middle East. Segment 4, geopolitics.
The shadow of a regional war. And it feels like it's getting longer.
I want to slow down here because this isn't just about money and markets. This is about lives. Where do we stand right now? What's the latest?
We are in a high-tension standoff. The U.S. Naval Battle Group, led by the aircraft carrier USS Abraham Lincoln, is deployed off Iran's shores. It's a massive show of force.
And the rhetoric has escalated significantly from both sides. President Trump said, quote, "We have the biggest, most powerful ships. Hopefully we'll make a deal." But he also mentioned a deadline has been conveyed.
A deadline implies an or else. That's what has military planners so worried. But what's more concerning to analysts is the shift in Iran's military doctrine.
Explain that. What's changed?
For years, the unwritten rule of the game in the Persian Gulf was proportional response. If the U.S. or Israel hit a radar site in Syria, Iran might fire a drone at a U.S. base in Iraq. Tit for tat. It was a way of managing escalation.
A violent but predictable dance.
Exactly. And now Iranian leadership's Supreme Leader Khamenei is signaling a major shift. They are saying that any strike on Iranian soil, no matter how small, will be treated as a declaration of full-scale war.
That removes all the off-ramps. There's no room for a limited strike anymore.
It does. It removes the ability to send a warning shot. They are threatening to immediately target U.S. bases in Qatar and the UAE, or even oil refineries in Saudi Arabia in response to any attack.
Why the shift?
Yeah.
Why back yourself into a corner like that? It seems incredibly risky.
Because the regime is desperate, and this brings us to the internal situation in Iran, which is dire. The regime is facing a massive, potentially existential internal collapse.
The protests.
The protests are unprecedented in scale and violence. We are seeing credible reports from human rights groups and journalists of 36,500 people killed by security forces during a crackdown on January 8th and 9th.
36,000. That's not a crackdown. That is a war zone.
It is a massacre against their own population. And I think we need to talk about the story of Sam, which the Wall Street Journal reported on. It really brings the human cost of this into focus.
I read that report. It was incredibly difficult to get through.
Sam was a teenager. He was shot by security forces during a protest. A medic treated him on the scene. He was alive. He was stabilized. Then security forces took him away.
And days later,
His father found him in a morgue, in a body bag. He had the original gunshot wound, but he also had a second single gunshot wound to the back of the head, execution style.
it's just horrifying. And it makes you wonder about the geopolitics. Is the U.S. deployment a distraction from this?
Yeah.
Or is it meant to be a shield?
That's the core debate in foreign policy circles right now. Is the U.S. fleet there to prevent the regime from lashing out externally, starting a war with Israel or Saudi Arabia, just to distract their population from the internal slaughter? A regime that is killing its own kids is a regime that has nothing left to lose, and that makes them incredibly dangerous and unpredictable.
And the markets are watching this nervously. Oil prices reacted, but maybe not as much as I would have expected given the rhetoric.
Brent crude hit around $72 a barrel. That's a 4-month high, but it's not $100. It's not a panic price.
So why isn't it higher? If the Strait of Hormuz is at risk, and we know 30% of the world's seaborne oil goes through that choke point, why isn't oil panicking?
It's the boy who cried wolf syndrome, I think. The market has heard threats about the Strait of Hormuz for 40 years. It hasn't closed yet. Traders are betting, perhaps complacently, that it won't happen this time either.
And what about OPEC? What are the oil producers doing?
OPEC Plus is meeting on Monday, February 2nd, and the expectation is they will ratify a pause in their planned production increases.
So they aren't flooding the market with spare capacity to keep prices down ahead of a potential conflict?
No, they're waiting. OPEC Plus doesn't act on headlines. They act on physical barrels. They want to see if supply is actually disrupted and ships actually stop moving before they turn on the taps.
So we are sitting on a powder keg, and the fire brigade is waiting to see actual flames before they even turn on the hose.
That is a very apt and very worrying analogy. The market is priced for a tense peace, not an active war.
Okay, let's bring this all back home. We have covered a massive amount of ground today, from the $5,000 gold spike to the Warsh doctrine, the vibe coding threat to software, and the tragedy and tension in Iran.
It's been a heavy week. A lot of moving parts.
So let's synthesize. If I'm a listener trying to plan my next move or just make sense of the world, how do I hold all these disparate ideas in my head at once?
I think the phrase to keep in mind is fragile expansion.
Fragile expansion. I like that. Break it down for me.
The U.S. economy is growing. GDP is okay. Earnings are generally okay, especially in tech. That's the expansion part. But this growth is standing on 3 very wobbly legs. That's the fragile part.
What are the 3 legs of the stool?
Leg 1 is AI. It has to deliver real, tangible profits, and soon. We saw with Microsoft that patience is wearing thin. If the AI productivity boom that Kevin Warsh is betting his entire monetary policy on doesn't actually happen, if it's just a money pit for CapEx, the stock market has a major, major problem.
Okay, that's leg 1. What's leg 2?
The Fed. We need to navigate this transition from Powell to Warsh, if it happens, without breaking the bond market. If the bond vigilantes wake up and decide Warsh is too reckless with inflation, long-term yields will spike, and that will crush the housing market and business lending. A policy error there could cause a recession.
And leg 3, I'm guessing, is geopolitics.
The Middle East. We need to avoid a kinetic war that spikes oil prices. If oil goes to $150 because the Strait of Hormuz closes, all bets are off. That productivity disinflation that Warsh loves gets eaten alive by energy costs. You can't have low inflation if gas is $6 a gallon.
So it's an incredibly delicate balancing act. All 3 of those legs have to hold for the expansion to continue.
Very delicate. And a shock to any one of them could bring the whole thing down.
Now, before we sign off, we have to do our constraint checklist, our risk warning. We discussed massive volatility today. Crypto crashing 20%, silver 30%. People lost their life savings this week.
Right, and I cannot stress this enough. This is not financial advice. We are analyzing the news, we are connecting the dots, we are not managing your portfolio. Markets are reacting violently to headlines right now. We are in a high-risk, headline-driven environment. Don't be a hero.
Please do your own research. DYOR.
Right.
Don't bet the farm based on a podcast or a tweet or a headline. Understand the risks you're taking.
Verify everything. Trust no one.
Okay. I want to leave everyone with a final provocative thought, something to chew on over the week. We talked a lot about Kevin Warsh believing that AI will double our standard of living and save the economy through this productivity miracle.
Right. The great disinflationary hope.
But at the same exact time, the market is severely punishing Microsoft for spending the money to build that AI. And it's punishing companies like Salesforce because that same AI might destroy their entire business model.
It's a complete paradox.
We are simultaneously betting on the AI revolution to save us from debt and inflation, while being absolutely terrified of its cost and its creative destruction of existing industries.
We want the omelet, but we are terrified of breaking the eggs. We want the future, but we don't want to pay for it.
Exactly. So the question for next week, and maybe for the rest of the year, is, will the market finally decide if AI is a tool for growth or if it's just a black hole for capital. Because it can't be both forever.
That is the question, and I have a feeling we won't have to wait long for the answer. Things are moving too fast.
Thanks for diving in with us. We'll see you next week on The Deep Dive.
Stay curious.